Well, July 24th and July 26th, they're going to be 24/7 for gold and crude. I think it's always a buying opportunity for gold, but that is provided that the investor has the capital that won't miss a house payment or a car payment to buy it. You buy it, you put it away, you store it, and 10 years from now, it'll be worth a lot more than it is today.
If seasonality continues to matter this time around, then we should be heading into a better time for gold and silver in the next few months. They've fallen enough, I think. This has been a brutal contraction or consolidation here. I think it's time for gold and silver to start going back up.
Gold and silver may be approaching a turning point after a painful stretch of weakness. Investors are watching for signs of recovery. Todd Bubba Horwitz and John Rubino discussed the outlook for gold and silver, focusing on market timing and long-term value. Horwitz noted that expanded trading access for gold and crude could create additional opportunities, while emphasizing that precious metals should be purchased only with money investors can comfortably set aside. According to him, gold remains a long-term store of value, best bought, stored, and held patiently for years. Rubino added that if seasonal trends continue, the coming months could provide a stronger environment for both gold and silver. He argued that the sector has already endured a severe contraction and consolidation, making a rebound increasingly plausible. Both speakers suggested that recent weakness may be closer to its end than its beginning, though they stopped short of guaranteeing outcomes. Their overall message was straightforward: disciplined investors with adequate capital should remain patient, avoid emotional decisions, and focus on the longer-term case for precious metals as economic uncertainty persists ahead. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Precious metals, and the reason there is that Asians like to give gold and silver jewelry as wedding gifts. And they tend to have their weddings in the spring, which leads the jewelers who need to buy gold and silver as raw material to make jewelry. They have to do their buying in the fall. So you tend to get a lot more demand in August, September, October, November, in those days, which lifts the price up. Although, seasonality hasn't been that big of a deal lately because there's been so much other crazy stuff going on out there. But historically, it's true. You get that kind of a trend. So you get price pressure, buying pressure, pushing up the prices in the winter and very early spring. And then the jewelers are done buying at that point. So demand goes down and you get summer doldrums for gold and silver in May and June and July. And we're there now, so it shouldn't be a huge surprise that there's that gold and silver have gone into kind of a boring stretch here where they spiked in 2025. They fell off hard in the early part of this year, and now they're consolidating. So that kind of fits with the seasonality thing. And if seasonality continues to matter this time around, then we should be heading into a better time for gold and silver in the next few months. And, here's hoping. They've fallen enough, I think. This has been a brutal contraction or consolidation here. And I think it's time for gold and silver to start going back up. But, we still got some big factors out there, especially geopolitical right now. We've got the Iran war not over by any stretch of the imagination, and Trump getting briefed on what it would take to completely invade the country and stuff like that. So we might be back full on in war again, and that might spike oil prices, which might put pressure on gold and silver. That kind of a scenario is still very possible. So don't look at seasonality as the only factor out there right now and jump in with both feet, because you've got other stuff going on. Just in general, don't try to trade this market. Just do things steadily and hope that fundamentals win out in the near term.
When you get a market that moves too parabolically, especially commodity. Now, again, there's stocks and there's commodities. Commodities aren't going out of business, right? They're not a company. They're a hard asset. You got overdone to the upside, gold, silver, and platinum. All three went to Pluto straight up. They have to come down at some point, and normally the correction is overdone to the downside. Anybody who's watching this, I urge you to take a look. You want to see it happen in real time in 3 days or 5 days, go take a look at the stock of SpaceX. Now, stocks and equities are not the same, right? But SpaceX exploded to 240, dropped back to 140, okay? That's what I expect. I wouldn't be surprised if gold hits 6,000 this year. I'm still not running away from my overall call. Yeah, it's pretty scary here. It's hard to watch, and it's painful when we see gold continue to go down almost every single day. But again, you have this problem with personalities and with psychology that people ran it up, there was no fear, and now those who are selling can't sell it fast enough. And of course, normally they are wrong. The masses are wrong. There's an old floor saying from the floor trading days, when you can see their tonsils, give them whatever they want, they're wrong. And I'm starting to see the tonsils of the gold sellers right now because they're selling in a panic fashion right now.
Gold and silver prices are moving through a key seasonal pattern that precious metals investors should watch closely. Historically, demand for gold and silver rises when jewelers buy raw materials ahead of wedding seasons, especially in Asian markets, where gold and silver jewelry remain gifts. That buying pressure often supports prices in late summer, fall, winter, and early spring, while May, June, and July can bring slower demand and weaker momentum. Recent market action fits that pattern, with gold and silver pulling back after a strong run and now consolidating. Still, seasonality is only one factor. Geopolitical risk, oil prices, inflation pressure, investor psychology, and broader commodity trends can all move the precious metals market quickly. Gold, silver, and platinum may look painful during corrections, but hard assets often overshoot both upward and downward before fundamentals return. For investors tracking gold price forecasts, silver market trends, safe haven demand, commodity cycles, and precious metals opportunities, patience and discipline matter more than short-term noise. Let's get back to the interview.
It's possible that we see oil continue to drop if they settle the Iran war, and that flushes a lot of the inflation out of commodities and saves the Fed from having to raise rates. In any event, they're not going to be able to raise much because we've got the same problem Japan has. We've got rising interest rates with a mountain of debt, which means the interest expense on our debt is growing parabolically. If you raise interest rates, that just turbocharges the parabolic increase in interest expense. And we can't do that for very long either. If we push interest rates up to, let's say, 4.5% for the 10-year Treasury, then we're in the danger zone. And we're risking a stock market crash, which leads to a recession, which forces the Fed to go back to cutting interest rates really dramatically. And so the Fed doesn't want to cause that. They'd rather have a much more benign inflation environment before they start making any big decisions for us to predict anything. So I don't know why gold is doing what it's doing right now. But the longer term story is pretty favorable because you've got governments around the world taking on insane amounts of debt, which at some point they have no choice but to inflate away. So low interest rates and QE are inevitable out there. So, if you're a precious metals investor, that's probably what you want to be focusing on, this thing that might be a few years out, but that is phenomenally good for precious metals. So just buy now in anticipation of that. And don't try to finesse things in the near term when you've got all these cross currents going.
They're starting to panic, which would suggest to me that we're probably seeing somewhere near a bottom shortly coming in. When you get this much open interest at these prices, that means that the boat is loading up on one side, and who's going to be left to sell the gold? We've seen some dramatic selling. I mean, gold is technically in a bear market right now. I mean, down 20%. So again, when you look at the bigger picture, this is telling us that you've got some people that are buying some downside protection against positions that they're holding. It's kind of like a hedge, but they're overpaying for it because the more people come in and buy, the higher the volatility goes, the higher the price they're paying, and the bigger the down move they make. This will never work out for them. This will probably end fairly ugly, and they'll be giving up a lot of their profits when gold does turn around and goes back to the upside. You've got over a 20% pullback in gold. You've got a hawkish Fed, which Warsh did I never compliment the Fed, but I'll compliment Warsh, did a good job. But you have a hawkish Fed, so higher interest rates are not necessarily bullish for gold either. So you have a little bit of bad news for gold going into a market that was already coming down to begin with. So you have people that are panicking that want to hold on to their physical gold or their paper gold. There's both, right? but physical especially, because you can protect your physical gold by buying puts in the market. I mean, I hedge my gold by doing back ratios and using these positions, but I don't think you're seeing, I think you're seeing some panic to sell, but you're not seeing much else going on. And that's what I think you're looking at. They've been hawkish for a little while anyways, number one. Number two, the only really way to contain this inflation is to hike rates. So we've seen some talk, and of course the Fed funds rate are pricing in a rate hike anyways, at least one to maybe two this year. So the true matter is that they're finally realizing that their ridiculous amount of manipulation of interest rates is being over-dominated by the true free market. You look at the 10-year notes, which have rallied quite a bit. You look at the other interest rate markets that are higher. So this is giving you a hawkish view. And of course, the only way to stem the tide of inflation is to raise rates. It's a major catastrophe. You've got a lot of things in play here. You've got private credit in big trouble, okay? You've got no money down loans coming down again in houses. You've got no doc loans coming. And so you're seeing a lot of the replay of 2008. Barring a major collapse in the equity markets, they're going to hike rates. The only time they're going to cut rates again and any time in the near future is if there's a major catastrophe in the general economy here. And until then, they're going to hike rates. And I think Trump may or may not be happy with his choice now in Warsh, but Warsh has been a little bit of a hawk. And the whole Fed, the whole meeting was a little bit hawkish, and they're pricing the Fed funds are at 65% that they're going to hike rates. So that would be the way that I'd look at it, and I think they will be hiking rates. If you're going to bring gold back as the dollar, backing the dollar, that would change things. But to reset, how are they going to are they going to reset price and hit a reset button? They can't do that. It has to be determined through the free market. So the only thing they could ever do with gold is decide, as some states have decided, that you could use gold as actual currency.
Yeah.
But from a straight reset, again, it's all nonsense. It's a headline that's out there that people like to talk to hear themselves talk. But overall, I put no stock in any reset on July 4th, other than the fireworks we're going to see from the park districts.
The discussion highlights a market environment marked by rising debt levels, interest rate uncertainty, inflationary pressures, and shifting expectations for gold. While short-term price movements can be unpredictable, the broader focus remains on how central bank policy, government borrowing, and economic conditions may influence precious metals over the years ahead. Temporary pullbacks, changing market sentiment, and investor positioning often create volatility, but they do not necessarily change the long-term factors driving interest in gold and other hard assets. What stands out is the contrast between near-term market reactions and longer-term economic trends. As investors weigh inflation risks, debt burdens, and future monetary policy decisions, gold continues to remain a closely watched asset across global markets. Understanding these dynamics can help investors make more informed decisions instead of reacting to every short-term move. If you found this analysis useful, make sure to like the video and subscribe to the channel for more updates on gold, inflation, interest rates, Federal Reserve policy, and broader market trends. Staying informed about these developments can help you better navigate changing economic conditions and keep up with the factors that matter most to investors.